The stock market's selling off today. Gold is rallying. Now, I wanted to break down the price of gold, taking a look at the price of gold versus other assets. And this is one thing that if you take gold and you look at it for what it is, just an asset, you see that there's been a relationship with the money supply moving higher and higher, gold prices moving higher and higher, and of course the stock market. But now the stock market is selling off. Economic activity looks like we are definitely heading towards a slowdown, if not a recession. But what about gold? Here's the thing, the big massive asterisk that you should keep in mind when you think about gold. The federal government is trying to provide tax breaks for the wealthiest. Fine, great, awesome policy. How are they going to pull it off? The fact is, we're seeing messages coming out of the news wires saying that the numbers are not adding up for them. This means we're likely to see a much bigger deficit than what they think they can pull off. They're trying to slash everything they can with regards to, say, getting into Medicaid and Medicare in order to pay for these taxes. They know that these tax cuts are going to add to the deficit, so they're trying to come up with some more money. It's not adding up. Because of that, the price of gold could likely continue higher as a hedge against inflation. Simultaneously, interest rates, not exactly a one-way trip downward. So there's going to be a lot of balancing going on, and I think that the Federal Reserve is going to have to restrict economic activity in order to contain price pressures. Interest rates themselves may be a little bit higher where they are right now, could come down lower, but not nearly as low as what we've seen historically over the past couple years. Let's jump in. I want to break down some of the things I'm looking at and what could happen next with the price of gold. Here's a look right here, the U.S. 10-year Treasury yield. And for me, this is where everything starts. This is the benchmark. But I wanted to give kind of a historical perspective. If you go all the way back to the 1990s, early 1990s, that's kind of the modern economy. Bush Sr. Lost the election because of a recession, a very mild recession. And, Clinton took advantage of that, came into office. We had the dot-com era, which was a lot of economic activity as the world ramped up for basically your iPhone, personal computers, the internet, things like this. The dot-com era burst in, I want to say the very peak in the stock markets were May 2001-ish, 2000, can't remember. Then, of course, if you look dead smack close to the center, 2008, of course, we had the financial crisis. Since then, economic growth was still growing, but not at as fast a pace. And because of that, the Federal Reserve themselves had to come in and kept doing QE1, QE2, QE3. QE4 was really COVID. It was all just this continuation. Interest rates, largely speaking, were lower than normal. But if you look in the 1990s, we were coming off of a hyper sort of growth era when there was higher levels of inflation, and the 10-year Treasury was maybe slightly elevated. But then we look at, say, post 2008 financial crisis, interest rates were slightly lower than normal. Then, of course, we have COVID, where you can see right there where the 10-year was touching half a percentage point. Now we're back up to 4.5%. And to be honest with you, this is fairly normal. But the economy itself is likely to slow down as these guys are the tariffs, plain and simple. Number one, we're already seeing economic activity contract somewhat. The consumer is restricting expenditures. We're seeing savings rates move up. Confidence is down. Unemployment will rise. We're sitting at 4% unemployment rate right now. That's a pretty solid unemployment rate. We used to think that 5% was full employment. So going beyond there was always a fearful situation because they felt as if transitional employment was so rapid that at 4% you'd see lots of inflation. We didn't. And so going beyond that 5% metric is kind of from a theoretical perspective, a new thing that we don't really. We had other expectations that just simply didn't work out. And one of the reasons is simply economic growth wasn't nearly as strong because of post financial crisis, 2008. All right, so where is normal? I think we're a little elevated, but I think we are right about where the 10 should be. From here, however, I see a recession occurring. The tariffs are going to seize up the economy. And it isn't so much what the tariffs are going to do to U.S. employment here as much as it is what international consumers are going to do to U.S. products. Canada, forget it. They're trying everything they can to not spend $1 on any kind of American-produced goods. Simultaneously, the costs of everything is going to rise. Given that, these tax cuts, if we had a full employment situation, we're running a 120% debt to GDP ratio. They're going to add to that with a 4% unemployment rate, which means we can't get there at an economy running full speed. The economy is going to contract further, which means from there, you're going to see higher deficits, bigger inflation. The 10 could remain elevated. I don't think we get to 5%, but let's see how bad they push the deficit, plain and simple. Now they're trying everything they can to come up with the cash for this, and they're gutting Medicaid and Medicare in order to pay for the deficit. They know very well this will be deficit. They know that. So they're trying to get that money somewhere else. And they're trying to, get ahead of that with saying as much as they can regarding their policies and how they believe this is the way America's moving forward. I've said in the very beginning, I think it was the beginning of this year, they're running 120% debt to GDP ratio. They hit 150 by the time Trump leaves. Can we manage that? We've been there before. The economy would have to grow. But with the tariffs, that is highly restrictive. So this is a big concern of mine. In the meantime, the Federal Reserve is likely to have to lower interest rates because of an economy that is contracting. So this could pull the 10-year downward. Now we look at gold. And this chart goes all the way back to early 1970s. And if you look, and I wanted to kind of start it right at that point, that's when Nixon got us off the gold standard. That's when things really started lighting up when it comes to inflation and growth and things of that nature, when we were removed from the gold standard. Do I believe we should get it back on the gold standard? Absolutely not. I think we should be on the Snickers standard, where the dollar's pegged to a Snicker or whatever. It's, I don't believe in that pegging system that you hear people talking about all the time. Why gold? Why not Snickers? Why not tennis shoes? Why not, some other metric? The fact is, it's pegged towards the growth of the economy, which is a whole basket versus a metal. So when we're looking at this, dead smack in the middle of this chart, gold wasn't exactly lustrous during the dot-com era. Investors were shying away from it because dot-com stocks were flying. Since then, however, you can see how the Federal Reserve moving in with their QE programs all through 2008, all through into 2012, 13, you can see how the increase in the money supply pushed gold. But it backed off a little bit. I want to show you the next chart. This is gold versus the money supply, M2. Generally speaking, there's some trend line movements here, and gold, while it has exceeded the money supply somewhat, it tends to be lower than the overall money supply, that there's a reaction to it. I see the Federal Reserve restricting money supply because I don't see them needing to have such a big money supply. We're already seeing signs that the money supply is declining. So this gives me pause when I see gold at 29.20. Sure, we'll probably clear 3,000. I'm sure a lot of people have that as their target, but I don't necessarily know that gold just keeps going. I think that the economy shudders and that interest rates are going to have to be brought back down. Because of that, assets by and large will be sold off, regardless of the deficit. That this is an asset thing. And here's a look at gold in the bar chart. Red is still money. Purple is the S&P 500. There's a high correlation between valuation of the money supply to assets. The money supply is being restricted. We're seeing the growth rate peter out at this point. The Federal Reserve is actively trying to restrict their money supply. Commercial banking, the money supply is being restricted as we speak. So gold itself, it's just something we pull out of the ground. It's not that special. And so people say, oh, rush in and buy it because it's a hedge against inflation. No, it's an asset, like any other asset. And don't look at it from that. Look at it from the perspective of its value is moving higher because of inflation. And from that, we are likely to see the Federal Reserve make shifts and bring everything down. So asset prices, generally speaking, are going to fall. It isn't the cause so much as it is the effect. That because the Federal Reserve is going to see inflationary prices moving lower, they can act, and from that, gold will react. That it isn't necessarily a hedge against inflation, it's a price movement, and that price movement might be done with, except for the deficit. What can they actually pull off? These guys are determined to push through their agenda. Today is the 6th, and I think it's the 14th or 15th that they have to hurry up and get something going through. And from that, we will see what they're going to do. They are getting money any place they possibly can in order to push through their agenda. Okay, fine. They are going to add to the deficit. Will we be able to swallow that? That becomes a supply and demand issue. And it may not have anything to do with whether or not investors want to come in and buy U.S. Treasuries because of our capacity to pay versus, say, they're just genuinely upset. Will Canadian investors shy away from U.S. Treasuries and buy European Treasuries or Canadian Treasuries or any other country instead of U.S. Treasuries? This lowers price to entice investors in, which pushes up yield. So the ripple effects of all this are huge. What these guys can pull off will determine a lot, including the future price of gold. How much is the deficit going to go up? I think it does go up. I don't think that they pull anything off. Recently we were as high as 1.37 debt to GDP, but that turned around when the economy picked back up and the deficit continued, but it didn't continue exasperatingly. So I can see gold prices remaining lofted, but I really want to see what happens with the deficit. In the meantime, copper. Copper is one of those things that we often look back at and say, if you want to know what's going to happen with the economy, take a look at copper. Copper's shooting higher. There are price pressures. There are ripple effects that are going to happen because of the tariffs and things of that nature. But ultimately, if you see copper prices moving higher, regardless of price pressures per se, inflation, there's demand, plain and simple. And if there's demand for copper, that means industrialization is occurring. So when I see copper prices moving higher like this, along with gold, I see economic activity moving forward. So I'm not we are starting to see a lot of ripple effects manifest, very likely over the course of the next 2 to 3 months. That's when you will see the price of copper falling, or simultaneously the price of gold. The reason? Because the economy itself, world economies, will contract. So demand for copper, demand for gold will fall, assuming these guys can also contain the deficit. But we're running at 1.2% at full employment. This guy's going to push unemployment levels above 5%. So this is going to be an interesting year moving forward. XME ETF. This is the metals and mining ETF. This one here, it's sort of a subsector of a sector, the material sector. And you're seeing, despite the fact you're seeing copper prices and gold prices moving higher and higher, costs for running these companies are increasing, and therefore their profitability is dropping. Because of that, I could see that once the price of the minerals that they're pulling out of the ground starts to move lower, XME, metals and mining, this is one that is going to move lower as well, by and large. But there's so many variables that are happening right now, and anybody who's been following me, I don't look at just one thing and say, yeah, I think the whole market's going to go up because look at this one indicator. I look at the whole thing, everything. I start with interest rates, I look at equities, I look at the sectors, I look at every single thing. I look at the money supply, I look at the consumers, and ask the question, how's this whole picture happening? You cannot look at just one thing and have an idea of what the whole economy is doing. We have a lot that's about to transpire. I believe XME, this particular ETF, moves much lower. Now it's trading about 56.5. We could see moves down to about 40, but let's see how bad the economy contracts because of the tariffs. Let's see how high the deficit moves up after they're done gutting whatever social programs they want to gut, while simultaneously the economy restricts and unemployment moves higher. The eventuality is gold moves downward. Given those variables, other variables may show up. And those are unknowns for right now. And this is why I'm constantly looking at all the various sectors, the consumer, the money supply, interest rates. Today, this is what we're looking at. Next week, all this could be washed out. But I expect the materials and mining sector, XME, ETF here that we're looking at, goes down over the course of, say, the next 3 to 6 months. Gold prices will cap out eventually. The Federal Reserve is going to have to restrict the money supply. Commercial banking, they will start to slow down their lending because businesses are not going to be borrowing as much. That restricts overall economic activity. The eventuality is that the run-up in asset prices such as stocks stops. We're already seeing the sell-off in the stock market. The big asterisk becomes the deficit. Do they kill it? By kill it, I mean debt to GDP ratio. Do they push significantly above 1.2 times, which is 120%? That's something that is a complete unknown until we get the information on what they're going to be pushing through. That's what you got to keep an eye on. Make sure to hit that like and follow button. I'm writing something up on my Substack. Links are available for that. See you in the next video.